Are you getting pressure from finance to justify or reduce your cloud bill? CloudZero is the only cloud cost platform loved by engineers and trusted by finance. CloudZero can identify unused, idle, or over-provisioned resources, alert you to spend anomalies, and organize 100% of your spend into a framework that mirrors your business structure, like cost per customer, product feature, or team. It's the most powerful platform ever built to provide accurate, granular visibility into your total cloud spend without the typical pitfalls of legacy cloud cost management tools like endless tagging or clunky Kubernetes support. Manage cost, optimize development, and maximize profit, all in one platform. Join companies like Rapid7, Drift, and SeatGeek by visiting cloudzero.com/cloudcast to get started. That's cloudzero.com/cloudcast. Visit today to experience immediate and ongoing savings on your cloud bill.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are, and welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Hope everybody's doing well. Kind of mid-March Sunday perspective. Usually we tend to do kind of, cloud news of the week on the Wednesday show and kind of give you an overview of what happened during the week. We try not to necessarily make this show one in which, if you don't tune in that day, that week, you're going to sort of miss it. We try and do more educational types of shows, sort of, evergreen shows, if you will. So, but this week, there was sort of a fairly major event in the industry. For those of you that follow or maybe don't follow, again, don't feel bad. There was a bank issue, a bank problem, a banking problem, if you will. A bank called Silicon Valley Bank, who is a very prominent bank, was either the 15th or 16th largest bank in the United States, predominantly targeting the tech industry, the tech sector, the investment community around tech and so forth, but also startups and other, just companies, big companies in tech, closed this week. And we'll kind of walk through the details. But what I wanted to try and do was not give a commentary on, why it happened or, what were the, did somebody do something wrong or point blame or, kind of make a comment on what next step should happen. But what I wanted to do, because I know a number of people have reached out, colleagues and friends and other people in the industry. And so man, what is going on? You have some business background as opposed to just technology background. Like, what is going on? How did this happen? What does this mean? So I thought what I would do is spend some time today kind of walking through what happened with Silicon Valley Bank, but more importantly, sort of explain just the fundamentals and the basics of, what happened as this relates to a bank, because we have seen a number of instances over time. They don't happen terribly frequently, but over time. And I feel like the last year plus, we've been going through some things in the news, whether it's, crashes or, layoffs or interest rate changes or just whatever that people maybe haven't necessarily seen in a long time. And, this is really the first sort of large banking shutdown since about 2008. Again, we can get into sort of historical things, and I'll try and put some stuff in the show notes. But what I thought I would do again is, a lot of people in tech, don't spend a lot of time understanding how the financial system works. The financial system is very, very complicated. I wouldn't expect anybody to do that. You should spend most of your time, focusing on trying to be good at your job and allowing financial professionals to do their job and so forth. But it is sometimes good to have some sense of, what happened here? What were the things that triggered it? Should I be somewhat worried about this, or is this something that happens in the system and the system sort of works it out? So I thought what I would do is just spend some time sort of walking through the basics. Again, not going to get into sort of hyperbole or opinion or anything about Silicon Valley Bank. You may come back and listen to this show 6 months from now because you don't keep up with it regularly and go, oh yeah, that stuff you talked about, none of that was relevant. So again, I don't want to kind of get into opinion or any of those things. I really just kind of want to walk through the basics of it. So for anybody that's reading things, they have a sense of like, oh, okay, that's what they're talking about. Okay, those were the actions that were taken. Those were the things that happened as a result of that. And, gives you not only a better sense of, what happens in the financial system, but I want to draw some analogies to things we talk about all the time in cloud in terms of resiliency and availability and, with how many providers you should work with and all that sort of stuff, because there are a lot of parallels between what's happening here and a lot of the conversations that are happening, in many cases on Twitter and so forth. But I'm going to dive into that right after the break.
Are you struggling to keep up with the demands of managing and securing identity in your distributed enterprise IT environment? You're not alone, but don't let it hold you back. With Strata's identity orchestration platform, you can secure all your apps on any cloud with any IDP, so your IT teams will never have to refactor for identity again. Imagine modernizing app identity in minutes instead of months, deploying passwordless on any tricky old app, and achieving business resilience with always-on identity, all from one lightweight and flexible platform. Want to see it in action? Share your identity challenge with us on a discovery call, and we'll hook you up with a complimentary pair of AirPods Pro. Don't miss out. Visit strata.io/cloudcast. That's strata.io/cloudcast.
They're better together. GitOps and continuous delivery. Join the CNCF on May 8th and 9th in Vancouver for CDCon and GitOpsCon. The event will foster collaboration, discussion, and knowledge sharing by bringing communities to start shaping the future of GitOps and CD. We're excited to offer a special discount code for Cloudcast listeners. Simply use the code PODCAST10 for 10% off when you register. Act fast. That's PODCAST10 for 10% off GitOpsCon and CDCon. And we're back. And as I mentioned, want to spend some time today kind of walking through some basics of, kind of explaining what happened with Silicon Valley Bank as best we understand it. Again, it is March 11th. This show will go out on March 12th. Silicon Valley Bank ceased to exist on March 10th, 2023. Most of the attention around Silicon Valley Bank has been in the last 3 or 4 days. They announced some earnings on either Wednesday or Thursday of this week. So there will be a lot that will come out of this later in the next few days, in the next few months and so forth. I don't want to speculate on any of that. I don't want to comment on any of that. I simply want to sort of talk through the few things that we know and then put that into context as to, what does this mean in terms of the banking industry? Because people in tech ask about those things because obviously you have jobs and paychecks and investments and things that you care about for your family, for a home, for loans, for whatever it might be. And then I also want to kind of connect the dots between similarities of analogies to what we do every day in tech and in cloud and so forth, so that you can kind of go, oh, okay, that is like this and that's like that. So let me start with some really basic things. So the most basic thing is, let's just take, the concept of a bank. The concept of a bank is you have money, you have cash, you have money. Maybe you got that money from a job, from however you obtain that money. And you are looking for, in your mind, a safe place to put that money, right? Because first and foremost, nobody needs to use a bank. You simply could buy a gigantic safe at your house. You could put locks on your doors. You could bury it in your backyard. You could hide the money under a couch seat. You could keep it in your pocket. Nobody is by any means required legally to have a bank. But you may have a situation in which you want to use a bank for various services. So the first thing that you tend to do when you think about a bank is you have money. You want to give that money to the bank. You want them to hold that for safekeeping purposes. Maybe you also want them to hold that because they're going to, be a place where you pay your bills out of. But in essence, you are using a bank to keep it in safe. And in return for that, for them holding on to your money, you expect some sort of return, some sort of interest to come back to you to pay you a little bit more money back for them holding on to your money, right? So you're sort of giving up somewhat of control of your money, and in return for that, you want some sort of return to come back to that. We call that interest. Now, that concept, the fundamentals of banking is based around this basic trust that you have with the bank. It's not a contractual relationship. It is a trust that the bank will remain solvent, will remain in business. And when you go to the bank to get your money, they will be able to give you the money that you put in. So let's say you and I'm going to use a whole bunch of hypothetical numbers just to keep things very simple. Let's suppose you put $1,000 into the bank. At some point, if you go and ask the bank for the $1,000 back, they will give it back to you. That's the expectation. That's the trust that you put into the bank. Now, many of you will say, well, trust is an interesting concept. I don't know that I necessarily trust the bank. So it would be nice if there were some additional things that were put in place to force the bank to create this concept of trust. And the good news is those types of things do exist. There are regulations in nearly every country, and specifically in the banking industry, to create a concept of trust, some sort of legal mechanism that will enforce trust. And we call that regulations. And so anytime you hear people talking about, well, if you work in technology and you're selling to banks, banks are oftentimes complicated to work with because they have to go through a lot of compliance and regulatory types of things. Well, those regulations are generally in place to reinforce the idea of this trust that you're going to have with the bank. Right. There's lots of other reasons for that, so that there's not fraud, so that there's accountability, so that lots of other things. But at the core of this is this idea that you trust your bank when you give them that money, that you're going to be able to get that money back, whatever level of money is still left in that account. That's the fundamentals of this. Now, let's take this a step further. So first and foremost, what is Silicon Valley Bank? Some of you might be hearing this and going, is that really a thing? Is that just some made up crypto thing? Maybe I've never heard of Silicon Valley Bank before. Is that some thing that is just the kind of generic name they use on the show Silicon Valley? No, Silicon Valley Bank is an actual bank. It is primarily based in Silicon Valley, California. So the San Francisco region, the Bay Area, that area. It's actually, I think, based in Santa Clara, but it's in that region that we think of as Silicon Valley. It is a real bank. It has real locations. You could physically go. There is a vault somewhere, all that kind of stuff. It is a real bank. It is, like I said, one of the top 20 banks in the United States in terms of they measure banks by assets, right? How many deposits have you taken in? So money that people have given you, and how many assets do you hold? Meaning, and we'll get into what that means. But they were a real bank. There is a real building. There is a real safe. They have all the same regular regulations that any U.S. bank has. So this is not just sort of some made up crypto bro thing on the internet. Whatever. It's a real bank. It's been around for many, many, many years, and it is widely used by the investment community, so the VC community around tech. Many startup companies will keep their money in Silicon Valley Bank. Now, they may keep them in other banks as well, but that is one place where many startups that have taken VC funding, but also many tech companies who are large in size, not just the $1 million, $5 million, $10 million VC funded Series A company, but companies that are worth billions of dollars or, do billions of dollars of business. So, legitimate bank, but does focus on the tech sector. And you may say, well, is that unusual for the tech sector? Because some of the bank names that I know, maybe it's a Bank of America or JP Morgan or, HSBC or something, they focus on lots of things. Well, it is not unusual to have a bank that primarily focuses around an industry. There are banks that primarily focus on the automotive industry. There are banks that focus on farmers, other things like that. So there are certain sectors that have unique characteristics in which banks want to specialize in those things. Now, it doesn't mean they don't have other types of customers. Doesn't mean they're not somewhat diversified. But Silicon Valley Bank is not unusual in its targeting of a certain primarily a certain sector. Okay. Now, let's go through some other basics of banking. Again, the basic input to a bank is going to be deposits, user deposits, or company deposits. So somebody, an individual, a group of people, a business is going to put their money into, their cash into the bank. All right. Now, the basic fundamental of how a bank works is, let's suppose the bank has $100 million in deposits. At any given time, the concept of a bank is, yes, there is this trust relationship that at any point in time, somebody or all the people could show up and ask for the $100 million back. But that's not usual orders of business. Most of the time the money sits there. Maybe every Friday it goes out for payroll. Maybe, some money comes in and goes out depending on the business making money or the business paying bills. But the expectation in general is that at any given point, the bank isn't going to pay out all the money back to the people. So what it does is it basically says, well, at any given point in time, I should always have some percentage of that money on hand. And the rest of that money I can then use to either make loans. So maybe they're going to, make loans to people who want to buy homes, or to business people who want to build a building or take on debt, whatever that might be. But they can use that sort of excess money, if you will, to make loans. They can also use that sort of excess money in order to make investments, in order to grow the bank, grow the assets of the bank, grow the value of the bank. And this is what most banks do. In fact, every bank does this, right? So they keep some percentage of the money on hand at all times. Let's just say, again, for simple math reasons, they keep 10% of that money. So they have $100 million in assets, and they keep $1 million in cash on hand. Again, 10%. That would be $10 million. So $100 million, $10 million on hand. The other $90 million, they will invest into different types of things. Again, they could loan the money out, or they could invest in things that they believe are going to give them a certain kind of return. And so a typical bank will create a portfolio of various types of long-term and short-term either investments or loans, and then things at various levels of risk, just like sort of any portfolio manager. And again, their goal is to find a reasonable balance between, how long the money is, how available the money is, how long the money is committed to other things, and then the various risk levels of those investments or those loans, right? So this is very common things. So, so the real concept of a bank is, in normal times, those regulations kick in, and those regulations say, well, at any point in time, the agencies, whether that's the government at the state level, the country level, the region level, what it might be, are going to set up certain rules, these regulations that say at any point we should be able to test a bank to validate that they are still within certain guidelines of being able to hold and have available the number of assets that are needed in order to satisfy those immediate customer demands on a day-to-day basis, and then also look at their portfolio and how risky that portfolio is. And depending on, at any given time, what that looks like, be able to put some sort of public rating on that so that people who might consider working with that bank have some sense of, is this bank sort of low risk? Is this bank medium risk? Do we need to raise a red flag because this bank has some issues? They've gotten out of compliance or outside of the ratios, right? So that's sort of what's going on there. The concept that people in tech should sort of understand is, this is a little bit like cloud computing, right? You've decided that you need a external service to help you do something. So, for example, you're going to use cloud computing. You realize that you have a choice. You could choose to work with one cloud, just like you could choose to work with one bank, or you could choose to work with multiple banks. Maybe you say, well, I'm going to put half my money in this bank and half my money in that bank. Maybe $1 million here and $1 million there. Similar to, you might say, well, I'm going to put some of my applications in this cloud. I'm going to put some of my applications in that cloud. And again, the hope is that the trust that you have with that cloud provider is, I'm trusting that you are an expert in these things. I'm trusting that the relationship we have will be somewhat consistent. I'm hoping that, I give you my application, you run my application, or I'm giving you my data, you store and protect my data pretty well. I'm not necessarily expecting to get all my data back all the time, but at some point, if we have a relationship that I want to get my data back, there are ways to do that. And kind of the big difference is there aren't really regulators in the cloud industry. I guess the regulators people would sort of argue in the cloud industry are, well, Are you using standards? So that gives people some sense of like, could I get something out of your bank in a normal way? But that's not really a regulation. And also, the industry sort of regulates itself. If some cloud is a bad cloud, it doesn't live up to its, quote unquote SLAs, which I guess are not really regulations. They're really more insurance. The market could vote to not use that cloud provider. Hence that cloud provider could go out of business. But, in our world, in the tech world, there really aren't regulations per se on the technology. But there are some guiding principles. There are SOC principles. There are, certain regulations that cloud providers have to validate that they operate in certain ways. So I guess in a certain sense, those are regulations. They could be HIPAA, they could be SOC, they could be whatever. So there's some parallels there, right? You can choose which bank you work with. You can choose to work with multiple banks. If you are concerned about your data or whether a cloud provider will stay up, there are opportunities for you to buy insurance that if the cloud provider fails or loses your data, that you have some mechanism to be financially reimbursed for that. In the banking industry, we will talk a little bit about the concept of insurance of banking deposits. You'll oftentimes see in the press now this week something called FDIC, Federal Deposit Insurance Corporation, which is a U.S. government sort of backed thing, which is essentially insurance on your bank accounts. So there are concepts of insurance within banking. There can be concepts of insurance either through an SLA or through external insurance in the cloud computing world, right? So there are those things there. Now, this is where we start to get into what happened with Silicon Valley Bank. So Silicon Valley Bank, like most corporations, like most banks, is building their portfolio of, with that excess money that they're able to use, beyond your immediate deposits. And in their case, they, had a portfolio, and some part of the portfolio, because interest rates at least in the United States, rose. They rose from about 2%, and we've talked about this a number of times on the podcast, rose to higher levels, 4, 5, 6, 7%, whatever they ended up being, right? So interest rates have risen over time. Now, where that matters is, as many of you know, that is first and foremost going to make, if you want to borrow new money, it's going to make borrowing that new money more expensive. The second place that comes into play is in the case of Silicon Valley Bank specifically, but this could be the case in anything, they had bought a number of bonds. Bonds are simply, buying debt and buying debt payments. It's a very common, way of building a portfolio. It's typically considered fairly low risk, with a sort of known cash flow that comes back to the owner of the bond. And then at some point in time, you get your money back. You're essentially sort of funding somebody else's debt. So it's a very common way of doing things. There wasn't anything unusual in that. But the one thing to understand about bonds versus sort of stocks and assets is as interest rates go up from, say, 2% to 5% or 7%, the value of the bond, the long-term value of the bond, what you would get back, goes down. And I'll put some things in the show notes. I'm not going to explain sort of how all bonds work. But so in the case of Silicon Valley Bank, they had a large portion of their portfolio or a portion of their portfolio in bonds. Interest rates went up. So those bonds on paper were going to be worth less. So that's not unusual. Now, let's talk about the concept of, so let's set the stage. They have a whole bunch of assets, deposits that have come in, very, very strong balance sheet for that. They had taken some of those assets and invested in various types of portfolio things. In particular, they had invested in a bunch of bonds. Again, not unusual. Interest rates had risen. That part of their portfolio, at least on paper, appeared to be less than the value of it appeared to be less than it was multiple months ago or multiple quarters ago. So now we get into another concept. In banking, because there is always the sort of immediate need to be able to say, do you have enough cash on hand? Do you have enough assets on hand to pay back people requesting their money back, there is sort of constant testing, constant validation going on of, well, how much do you actually have on hand versus, what do your sort of assets versus debt look like? And if your, amount of debt that you have goes up, the things that you owe go up, there is sort of the immediate push that says, well, in that case, you need to sell off some of those assets, take those assets out of your sort of investment side of what you do, and put them into the money available to be responded to with deposits, right? So you're kind of having to get back to that ratio of, again, this isn't the exact number, but just for our sake of discussion, let's get you back to that 10%, right? And so what happened with Silicon Valley Bank was they announced their quarterly earnings. They highlighted that some part of their portfolio had been valued lower than it had previously. And so what they had done was they sold some of those assets. There was a loss involved with that, and that's not unusual. And then they were going to try and raise some money through the debt market or other ways in order to get their ratios back in line. So they were doing normal things that any bank would do when their portfolio gets slightly outside of the ratios and trying to correct it back to normal situation. Now, so I've been talking for 20 minutes. Brian, get to the point. Why did all this bad stuff happen? So essentially what happened was when they announced that, there was a set of communications that went out to the marketplace. Most people who look at the communications that were made by Silicon Valley Bank, have sort of said, well, those communications weren't done terribly well. They weren't done illegally. They weren't done fraudulently. They just weren't communicated to sort of all of the constituents maybe that should have understood things. Maybe they didn't do enough follow-up and Q&A, whatever it might be. And this brings us to sort of the high point of the story, which is the worst thing that can happen to any bank, not just Silicon Valley Bank, but any bank, is to have what's called a run on the bank. What that means in the most basic terms is everybody who had put their money into the bank suddenly comes along and says, I want my money right now, right? Like, let's go back to the basics. Let's say $100 million are in the bank. In this case, it's $22 billion or whatever is in the bank. But again, $100 million in the bank only keeps, say, 10%, $10 million on hand for those people. Well, if all of a sudden $100 million worth of demands from people saying, hey, give me back my money because I'm concerned, I'm hearing rumors, I'm hearing innuendo, subjective opinions that maybe this bank isn't as solvent, isn't as strong as it perceived itself to be or portrayed itself to be. I'm worried about you. Give me my money back. And so in the case of Silicon Valley Bank, there was what was called a run on the bank. Not all, many of the people who had deposited their money were either told by their VC investors or they were reading Twitter. However they sort of got wind of this or were suggested or pushed in that direction, there was a run on the bank. And essentially what happens when there's a run on the bank is, number one, people are going to show up at the door. It's typically going to be first come, first serve to get the money out. And then at some point, the bank doesn't have enough money to satisfy all the immediate demands. And so the bank begins to start, doing the things they can do to, sell things off, get cash from various means to service those deposit responses. But at some point, you can very, very quickly, and this is exactly what happened here, you can very, very quickly, A, run out of the money that's available to give out to people, and B, your ratios get incredibly out of whack to the point in which the regulators, in this case, you'll see the California regulators and the FDIC step in, and they say, you are no longer a viable bank. You have gotten so far outside of your ratios. You don't have enough immediate cash to satisfy all the demands of people that are coming to you. And you have not been able to show us that you're able to obtain additional money, additional cash in some way, shape, or form to satisfy all these demands. And so partially as a response to prevent wider spread panic in the industry or in the banking sector, the FDIC and the regulators step in and they say, we are, at least temporarily, sort of shutting you down and we're taking over your operations. And that's essentially what happened with Silicon Valley Bank. In the most basic sense of things, their portfolio got somewhat out of kilter. People can argue as to how bad it was or how good it was or all those things. I'm not going to make any comments about that. Details will come out later. But there was a panic that this bank was not going to be capable of doing what they needed to do, that they weren't going to have the money. And there was a panic and a run on the bank. And that run on the bank simply means more people went asking for their money back than they had immediate money available. They weren't able to find other ways to satisfy the immediate needs of those people. And they were, at least temporarily shut down. Now, what's going to happen with Silicon Valley Bank? Lots of things. There's lots of speculation as to what happened. Just to give folks a sense, and I'm not making any speculation. I have no insider information. I'm not predicting what will happen. There typically are, a few different options that would happen for any bank that goes into retainer, is sort of taken over by the government for at least some period of time. Number one, they could default. There could be, essentially declared a failure of the bank, in which case the people who had money in the bank may not get their money back. Now, that's, again, I'm not going to speculate on what could happen or what happened, but that is a one option. So the bank fails. People who had their money in the bank can't get their money back. The second option is the bank gets acquired by somebody. And this is not an unusual situation. For those of you that are interested, go back and search for something called Washington Mutual. This happened in 2008 when the housing market crashed. That bank was then bought by, I believe, Wells Fargo at the time. So it's very possible that another bank could step in, a larger bank, maybe a bank that's maybe in better financial situation, could step in and essentially buy what is left of Silicon Valley Bank. They would then take over all of the obligations and the assets and the portfolio of what was previously Silicon Valley Bank. That could happen. I don't want to speculate as to percentage of what happened, but that is a possibility. The third possibility is that, similar to 2008, the federal government or even the state government could step in and say, this is so catastrophic for our industry, for the economy, it ripples and affects so many people that in order to stabilize the situation, the government may need to step in and take some sort of action that would infuse capital into this situation. Now, again, not making any speculation. I don't know that could happen or not happen. Not guessing that it will happen, but that is something that in the past has happened, in which the government steps in. They look at the full ramifications of what's possible. The rest of the industry hasn't stepped in to necessarily mediate this or buy it out or whatever. And sometimes the government, for the good of the broader set of people can argue whether that's good or not, would step in and take some sort of action. That's a possibility as well. So it is, again, it's Saturday, the 11th. This all happened yesterday on the 10th. Things may change tomorrow on the 12th or the 13th or the 14th or a week from now or a month from now, who knows? But those are probably the three most likely outcomes. There could be others. Again, the banking industry is very complicated. What I wanted to try and do, though, was try and explain what happened here, kind of the fundamentals of the banking industry, what happened with Silicon Valley Bank, and what could happen going forward. I'm not going to comment on how much this impacts VCs or startup companies or anything along those lines. But that's kind of the basics of what happened here. There's probably a lot more that we could dive into. We typically don't go more than 30 minutes. I will try and put some links in the show notes that talk about some good explainers of some of these things. Again, just the basics of, what is, how does banking work? How do interest rates impact the value of things? What does it mean to have paper value versus have actual value? What does it mean when creditors have to do something like mark something to market? Meaning, well, the value of the market says it's this, but if I had to sell it, what would it actually, what value would it get? There's a lot of nuance and complexity and things involved here, but wanted to kind of explain the basics just so if anybody's digging into this, they can go, oh, okay, hopefully 30 minutes helps me get the basics, fundamental thing. I kind of relate to, kind of what this means from a cloud computing perspective. again, the analogy I think of from a cloud computing perspective is people will argue, well, maybe you should have used multiple banks. Okay, that's possible. It's sort of a similar argument in terms of risk mediation or spreading risk that people have of should you use one cloud versus multiple clouds, right? Same sort of argument. Does it make sense? Maybe. Is it more work? Is there more involved? Yes, possibly. Would that be a good idea? Well, it depends on your risk profile. It depends on how much additional work you're willing to take on to mediate risk. Should the bank have, been as risky about what they did in their portfolio? Sure, you could argue that. You could argue the same thing about, should people be concerned about AWS now that AWS generates so much revenue and profitability for Amazon? Does that mean that it will somehow change their motivation of being customer first versus being, profitability first? I don't know. It might in the future. It might change that in the future. That's something that people, again, have to think about from a broader risk perspective. Is this a usual thing that happened in the banking industry? Well, yeah, we do see interest rates go up and down. Does this happen to every bank? No, not necessarily. Some banks have, different portfolios. Some banks make certain decisions. In this case, Silicon Valley Bank made reasonable decisions, people would argue, but maybe they didn't hedge their risks very well, or maybe they didn't make all the right decisions, and maybe they were surprised. But again, this is not unusual in the bigger sense of things when you run big systems. It's very similar to what we saw in 2020 or 2021 when we were hearing stories about, for example, with Azure, where because we had shortages of being able to get chips, it was harder to get servers. And we heard things like, well, Azure was sort of running out of capacity and had to, kind of turn off services or throttle services, for people that weren't their best customers, right? So it's not unusual to have changes in a market, things that maybe weren't expected. Maybe you could have hedged them, yes, but in some cases you can't hedge them. And there are going to be downstream ramifications for customers, for levels of service and so forth. So again, there's going to be a lot of people with a lot of opinions on Twitter about this. Be careful about sort of jumping in on all of them. People will be emotional. This is going to be something that will create a lot of emotion. That's fair. But again, this is not something that is completely unusual for the banking ecosystem. There are very many parallels can be drawn to the cloud computing ecosystem as we become more and more dependent on, a fewer number of providers of things for us. And it's very important to try and understand kind of the broader picture of what's out there, because while you may not care about all the details of the banking system, you may not care about all the details of the cloud computing system, there may be some very important details, some things that impact your ability to operate your business. Your risk profile may not align exactly to their risk profile. All these things should be taken into consideration. It's really, there are no necessarily right answers or wrong answers, but it's good to be educated about these things. So hopefully, this 30 plus minutes or so helped give you some basics and some ideas of stuff. Always open to answering some questions for people for things that we are knowledgeable about. I will avoid the things that we are not deeply knowledgeable about. I'm willing to point you to other people, but hopefully this was, at least somewhat helpful to understand what are going to be a lot of Twitter threads, a lot of headlines, a lot of opinion pieces written, hopefully a lot of postmortems come out of this, hopefully just a lot of understanding. Because again, while we have problems like in the cloud computing industry, we have an outage, maybe it's an AWS region, maybe it's whatever. The more we can learn about them after the fact, hopefully we can build better resiliency into systems going forward. So anyways, with that, I'm going to wrap it up. Kind of a long one. Again, this one may end up being very timely, may end up being completely irrelevant in 6 months. I don't know, because again, there's a lot that we don't know, but I wanted to try and get some basics out there for people. Anyways, with that, I'll wrap it up. Hope everybody's having a good day. Hope everybody's having a good week. Thanks to everybody for listening. Hope you enjoyed the 700th show with James Governor. I thought that was a great one. We have a lot of really good stuff coming up in the next couple of weeks and months. And with that, we will talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.